Hi there, traders. This is Brad Gilbert with the FX Market Insight for Friday, the 6th of March. All right, now as we just have a look through, the data that came out of the US and to see where the markets are at, we had a bit of a mixed bag here on the US numbers. Jobless claims a little bit better, the factory orders a little bit worse. It's a bit of up and down, but as I said yesterday, the fundamentals are being pushed aside. Now, one of the key things to watch here is US equities, right? They're down 3.5% today. Now, is this back on the back of, the data? Is it on the back of coronavirus? To me, the whole focus is now starting to switch over to the US Treasuries. If you look at the 10-year bonds, right, this is where it's supposed to predict or determine a recession. Okay, you got the 10 years here, right? So if you look at the yield curve, if this starts to come down further, right? So 10 years is going to be worse than say 5 years, then you're looking at definite recession. And this can actually sort of invoke the whole recession. If the bonds start to move, especially the 10 years, and they start to go sort of inverted against the other lower timeframes, well, then you're going to start to really see. That tells you that down the track, investors expect worse conditions, and that can start to see a run on the whole equity side of things. If you've got investments in different things and we're talking recession, or we're talking bad times, this is where US equities can really start to take a hit. Now, if you look at the result there on the US equities, have a look down here on the risk on, risk off pairs, which is the yen crosses. There's no clear direction here. So there's a breakdown here between the equities and what's happening on the yen crosses at the moment. Right, this is the start of the new day for the Asian crosses. So we'll have to see how they play out. I would expect the other equity markets, Asian equities and European equities, to get hit as well. We'll have to see how that plays out. But this is where markets start to discombobulate. They start to focus. This is where your understanding of not only core FX markets, but the relationship between the equity markets and the bond markets is very important. All right. So this is why you go through the training to make sure you understand what's happening. Now, if we put this into context, have a look at the major pairs here. Right. You've got, and this is where opposing central bank sentiment comes into play. Now, the Aussie and Kiwi, I've widened the time frame out here, so you wouldn't sort of it wouldn't look like they're in down trends at the moment, but they are. Now, the Aussie and Kiwi have both stalled. If anything, they're coming back to test recent resistance. The RBA, RBNZ, both sort of dovish. You've got downtrends. The Aussie and the Kiwi are both caught up in the coronavirus. They're also caught up in the whole China weakness process. So there's good reasons why traders aren't buying these. But I tell you what, if the dollar continues to fall, well, then we're going to start to see these currencies. They could potentially pop to the top side. Now, the market's short. It's pretty hard to find buys for these, but you would expect some sort of movement to the top side. And that's exactly what we're seeing in euro. It's moving to the top side just on that dollar weakness, right? So, and just check out the price action. This isn't easy, right? You look at the, a few little false breaks on the top side, even euro sort of testing that short-term support level, breaking through, but not really running with it. Same with sterling. Now, dollar CAD just trading sideways, oblivious to what's going on. Dollar yen is starting to crank in, and we're starting to see it move to the downside as well. What you want to do is keep up the speed here with where the recent resistance lines are. We're starting to see a bit of a sort of fan process there. 107.22, we're starting to see some resistance there. But once again, it really comes down into isolating the best trading opportunities. So if I just bring you back to the MyFX Trading Hub. Now, once again, there's been no change. I've had less work to do this week, primarily because the trading conditions have been poor all week, loose. When I talk about poor, I'm talking about there's no clear, core hub of direction. If you're in the North American session, keep an eye on those equity markets. That's where the main driver is. So at the moment, coronavirus, UK-EU trade talks, well, that's sort of diminishing, but we're just starting to see the flow-on effect where the markets are just impacted from multiple events. Active pairs at the moment, well, the Fed sentiment running off the back of what we're seeing in the movement in the benchmark 10-year Treasury bonds, okay, the yields, that is suggesting we're going to see further rate cuts from the Fed, and that's pushed the dollar into a very bearish sort of sentiment. The dollar yen, dollar Swiss moving to the downside. Dollar CAD is the odd pair out, doesn't really want to play the game. You're starting to see a bit of a movement here. Obviously, the euro's going up, but we don't have, as I said, this is in the watch list primarily because the movement is on the back of geopolitics, which is impacting the euro from around the back door. Okay, it's going up, but yeah, it's only going up because of that dollar weakness. Sterling, Aussie, and Kiwi, well, you've got downtrends matching up with US downtrends. It's a bit of a wait and see situation. So I'll be concentrating on the dollar pairs. And as we come into today's trading, you want to be very focused on where the action is going to be. Now, the Aussie will have a bit of a chance for movement in the Asian session. You know what? Weak Aussie numbers here just feeds the Aussie. It's not going to go far. To me, there's a bit of a pressure build up on the top side. We get really strong numbers here, and it goes against the reason why the RBA cut rates. We could see it pop to the top side. That, to me, looks like the best possible opportunity. You know what? I think it's still a short-term trade, nothing I want to fall in love with. Then you come into that North American session. It's going to be all action stations. Obviously, the every second month, the Canadian and US employment numbers are released at the same time. This is going to be pretty frenetic for the dollar CAD, obviously with both numbers impacting that pair. US non-farms obviously impacts all major currency pairs, so everything's going to be active. Will it impact? Well, you know what? I don't think it's going to be that big a deal because the market is really concentrating on external markets. And that's what I'm talking about, the bonds, okay? So if the market's starting to factor in more Fed rate cuts based on the bond movements, well, you know what? The non-farms isn't really going to help. The only thing where it would come into play, okay, you get non-farm payrolls coming out weak. Well, then that fits the picture we've currently got, and that's where the markets will run, right? And the Fed may be pushed into cutting rates even sooner than their 18th of March meeting. All right, guys, so it's pretty active. Don't worry about the US Democratic race. I mean, it's between Joe Biden and Bernie Sanders. That's not really impacting the markets at this point. As I said, the US fundamentals are being pushed aside. It's all about the coronavirus, the impact on the market. The Fed's cut rates by 0.5%. We're now seeing the 10-year Treasury yields fall. It's pushing the market towards a recession as the media has been creating, and that's where the focus will be. So tricky conditions, look for the easy trade. As I said, for me, US employment numbers, really weak numbers, goes with a weak dollar, and we might see a good trade here, potentially pop. Euro, sterling, Aussie, Kiwi could pop to the top side. It goes with the current sentiment. If the non-farm payrolls are actually strong, it goes against the general sentiment at the moment anyway. We might see a little bit of the dollar rally a bit, but not much, right? It's all about the Treasury yields at this stage. So make sure you, if you know what you're talking about and know what you're doing, keep an eye on these Treasury yields. Also keep an eye on the numbers as they roll out. Now, don't forget the non-farm payrolls. If you're thinking this is a big payday, well, you've got about 6 or 7 different variables. And don't forget, you've got the Canadian employment numbers as well. This is as tricky as it gets, right? So you probably want to see these numbers roll out, see what the impact is on the equity markets, and then you can start to piece together whether this is going to be a good thing or bad thing for the bonds. Now, if the equities are falling, right, and the bonds are falling as well, I tell you what, this is getting into murky grounds. We're going to start to see some high volatility, especially on the equities, and that'll flow into the currencies as well. So hang on to your hats, decrease your trade size, and get ready to trade. All right, guys, have a good one. Cheerio.